We do have the major averages under a little bit of pressure today. Not all that much. S&P down about a little more than 1/3 of 1%. Dow gives up 50,000. Once again, obviously, we're watching rates. That's the biggest deal. Oil actually is lower today. The 10-year hitting a high of 463. It's the highest since February of 25. So you're looking at more than a year since we've been there. But the commentary feels like it's changed. I mean, at least in some respects, around what rates are doing. Traders now see the Fed moving as a hike. December hike has a 51% probability. January 60, March 71%. Yardeni's talking about a July hike. Mike Wilson, Morgan Stanley, if bond volume rises with rising rates on the back end, we would expect a first meaningful correction in equity prices since the markets bottomed in March. Joe, you get the first shot at this. Are rising rates now the biggest risk to an otherwise really good story?
So I think rising rates have you in the ready position to take action on how much you have played offense so far in Q2. If you think about the competition in the headlines in Q2, it was dominated by AI on a daily basis. And I think we kind of reached this moment where it was as intense as it ultimately probably could be with Cerebus's IPO last week. Now you have competition, Scott. You have competition because, as you mentioned, a 10-year Treasury is at 4.60. And for the Trump administration, this is their real first significant economic challenge internally within the market, even more than crude oil itself. If you pull back the lens and think about when President Trump was inaugurated on January 21st of 2025, 2 days later, a 10-year traded 4.66. They've had the benefit of 10-year yields really acting in a very benign capacity. So this is a challenge to the headlines. This is a challenge to the Trump administration. And from a strategic standpoint, first and foremost, it's a challenge to the momentum factor. And the momentum factor is the driving force right now in the market. I think that's most at risk.
I mean, Shannon, if this is the pullback that you're getting on a day where rates, continue to have that wave higher, I think many people would take that because they would believe that the growth trajectory and the AI story are resilient enough to overcome that. UBS talking about that today. Yeah, we could get some consolidation. It wouldn't be a surprise after we've been up for 7 weeks in a row. And they don't expect higher yields to derail the positive outlook because growth has remained resilient. There's so much optimism around the AI story that, if the market was uber concerned with a move higher in rates, probably wouldn't look like it does today. Now, Joe's point is fair. Growth and tech is getting hit a little bit today because as rates go up, obviously those are less favorable positions to be in for a day.
Yeah, this hasn't necessarily been all that unruly either. I think we've had periods where the rate volatility has been significantly more amplified over the course of the last couple of years. And so if you look at what the bond markets are pricing in, they're really pricing in our view, on the long end, this growth scenario. And I think that's a confluence of growth and inflation. And our view is actually on the short end of the curve. We're probably, we believe that it's still a little bit of overreach on the rate story. I think you're talking about derailing, and if this is just a growth story, and we expected this concentration, this narrowness in the market to persist, but yet you have a broader story in terms of economic momentum, manufacturing reacceleration, CapEx is broadening, 10 out of 11 sectors posting stronger earnings this past quarter. So right now, the market has been concentrated from a performance perspective in those areas that have done well from an AI adjacency perspective. The reality is, though, Scott, is that the underpinnings of economic growth are there. The last thing I would note is that our view is that we don't necessarily need the Fed to be meaningfully more accommodative in the second half of the year. And so we're not pinning this continued economic growth on rate cuts.
No,
and
I think that conversation's changed. I think you need to sort of, I think investors need to change that thought process and say, yeah, we don't need cuts, but what if we have to deal with hikes? Like the conversation I feel on Fed, on policy has shifted enough that needs to be the debate. In other words, Ed Yardeni, who's been one of the biggest bulls on Wall Street, right? 82.50 is his target for year end. He stays with that today, but calls for a July hike. That is a complete change of pace that even some of the most uber bullish strategists on the street say, yeah, the Fed could actually hike in July. Now, I don't think the market believes it for a minute that the Warsh-led Fed is going to do that. Could only imagine the missives that would come from the White House if that was even seriously entertained by the incoming and new Fed chair. But I don't think the market buys that for a second.
No, and our view is that they shouldn't. We disagree with that here. We don't think that the Fed is going to hike rates in July, and we don't think it because there just isn't the transmission to core CPI from higher energy prices that we would anticipate. Consumer spending is likely to slow incrementally from that discretionary wallet being cut into by high energy prices. And Scott, we aren't really seeing a robust level of wage growth. I mean, wage growth is moderating. So, that sort of speaks to still not a maximum employment situation, which gives the Fed time to wait and see, which is our view.
How do you see this year? We hit a new highs numerous times last week. Yep. We ended with a whimper as rates went up and oil was up. And the market was ripe for something anyway, because the market had gotten so top heavy and so narrow that all it took was just a little inch of concern. And all of a sudden you had a reasonable sell off on Friday. Again, nothing of great magnitude. And here we find ourselves. Rates are up. Market's not down all that much. Tech is obviously getting hit. The NASDAQ is worse than the others. But even so, it's not that big of a deal.
It isn't. But I think what still is concerning to me is about the breadth of the market. Only 44% of stocks are still trading above their 50-day. You talk about the narrowness. I think that's an increasing concern as that story continues to evolve over the next couple of weeks. I think as we turn back the clock to last week, however, yes, a lot of the inflationary numbers were kind of priced in, but there was a double on PPI. On core CPI, that was warmer than expected. So those are definitely concerns for me going forward. Yes, yields are moving up across the curve. Oil is down a little bit today. Nothing substantive coming out of China this past weekend. So I think there's a couple of things in the crock pot that are pulling the market down slightly. But to your point, it's nothing substantial. So I think the earnings story has been good. We'll hear from retail this week, which I think will continue to move it further.
I mean, Weiss, as I was saying, so S&P's up 10%. Right. They're about year to date. Tech accounts for 85% of that. Okay. The S&P excluding tech returned just 3%. So that speaks to the narrowness. Like, look, until we see a rate hike, I don't think anybody believes. Like, you can write about it and you can talk about it, but I'm not sure that we really believe that the Fed's next move is going to be a hike. And if that does happen, the market's not going to look like it does. It's not going to be hanging around the hoop of record highs if you get a hike in rates.
Right.
Period.
The bond market's telling you that, or the bond market is hiking itself. So if the Fed comes in, it's just the Fed rubber stamping what the market's already telling you. And if you take a look, the correlation, there's always some correlation, some degree of correlation between rates and equities, right? An inverse correlation. But if you take a look at the last 3 months and the last month, you'd see over the last month, that correlation is 1-to-1. And that's the troubling part. So I think we're at a lull in oil prices right now, meaning that I think they go higher as long as we keep with the blockade. So when you look at the situation that's there are two options that Trump has. One, and he's threatened this, I don't know that he'll actually do it, which is that renew hostilities. That won't be good for oil prices. The other is maintain the blockade. That won't be good for oil prices. And of course, the third option is that he finds a way to hit the off-ramp with a dialogue that his base will believe, and that's always an option. But overall...
Well, it's not that his base, it's not that forget the base, it's the markets at this point.
Well, I correct myself.
As you get closer to the midterms, you got to believe that the president's going to do and say whatever he thinks he has to do and say to keep the market from having any kind of dramatic move lower. I mean, how many times do we need to see the movie to understand what the plot is?
Right. Except here's the difference. I think at this point, the bond vigilantes, which include focused on the deficit's going to be $1.9 trillion this year versus $1.7 trillion, which is already a record. So all that's conspiring to drive up rates. So I don't think there's an off-ramp for rates. So I wouldn't be surprised to see a 5 to 10% correction. As you recall from show on Wednesday, I put on some hedges. I've been lightening up some positions. I think that with Paul Tudor Jones starting the dialogue that we're a year or two away from this ending actually brings forward the ending, right? Because nobody wants to be the last one out. So I think that's what we're seeing in the AI trade now. So, so I have concerns. Now, it could all turn on a dime, of course, and that's why you can't be short. So
sure,
hedging's different than being short.
Nobody likes to be in the midst of what a 5% correction feels like in the moment. But this is one of those markets where you have a 5% pullback. Everybody's like, oh, that kind of feels kind of nasty. And then at the end of the 5%, everybody's like, oh, phew, was waiting for something like that because the market was ripe for it. You were getting into unhealthy places where everything was like up and to the right.
Can I just add one thing, though? 5 to 10%? That's the market. There's going to be a much bigger correction in the AI trade. So it's going to keep to 5 to 10% is because the equal weight just hasn't moved as much. So that's going to be the ballast for keeping the overall indices from going down further.